It's the fear of the rate hikes and this, inflation fight that caused gold to go down. But what investors really never understood was that the Fed was not going to be able to succeed in returning inflation to 2%. I mean, it's possible that they could lower the rate a bit, but not even for that long a period of time. Eventually the rates would go even higher, but that we're not going to get back to the days of 2% inflation or lower than 2% inflation. And as investors start to realize that reality, the price of gold is going to go way up, because gold is worth a lot more in an environment of high inflation than in an environment where everybody thinks inflation is below 2%. And so I think that's what's happening now as the central banks are maybe getting closer to the end of the rate hiking cycle, because the countries are so indebted that they can barely even afford the hikes that have already taken place, even though interest rates are still negative in real terms. I mean, there's no central banks that have been able to move their interest rates to even equal their inflation rates, let alone exceed them. But I do think that more and more people are going to be realizing the box that the Fed is in, and also that not only are they not going to succeed in bringing inflation back down to 2%, but soon the Fed is going to be fighting a different battle. It's going to be trying to prop up a sagging economy, a deflating stock market or housing bubble, and helping the U.S. government finance even larger budget deficits than the one it has right now. So they're going to go from fighting inflation to creating even more inflation. And obviously that's very good for gold. Probably happens sometime next year, where the Fed is officially more worried about the economy than inflation, even though inflation may in fact have risen. But if you start to see a big increase in unemployment, and in particular you start to see a financial crisis unfolding, you start to see banks failing and other companies unable to meet their obligations and starting to fold, that's going to scare the Fed. It's going to scare politicians a lot more than inflation, even though in the long run inflation is worse. In the short run, that's not what the politicians care about. And the central bankers are really just politicians disguised as bankers. They're not really independent. So I do think that the focus is going to shift. Right now they're very public about they want to fight inflation because the public is upset about inflation. Inflation is a big problem. Everybody is dealing with it. Prices are up now, over the last couple of years, even the way the government measures them, I think they're up about 15%. But that means in reality, they're up about 30%. I mean, that is a huge increase in the cost of living. That's why so many people now have second and third jobs, because their paychecks have not risen nearly as much as their cost of living. And so they can't get by with one job. So they need two or three. And that's where all this job creation is coming from. But I think once the voters are more concerned about something else, then that's when the central banks are going to pivot, or the Fed, and try to prop things up. Except it's not going to work this time, because the way the Fed has always bailed out the economy and bailed out the markets and the government is by creating inflation. Well, it's one thing to do that when inflation is 2% or lower. It's another thing to do it when it's 5% or higher, because the justification for the cheap money was always that, well, we don't have enough inflation anyway, so we can kill two birds with one stone. We can get closer to our inflation target, and then we can also provide the stimulus. But what if you're double or triple your inflation target, and then you're going to throw gasoline on the fire in order to stimulate the economy? It's not going to work, because you're going to have a dollar crash, and then inflation is going to go through the roof, and that's going to complicate the problem that the Fed is trying to solve. And I think they're missing the mark on inflation, and everybody is just trying to figure out, has inflation peaked? And we got the CPI numbers today, and that's got a lot of people saying, you see, inflation has peaked. It's not about whether or not it's peaked. I don't think it has, but that's not the real important fact here. The important fact is that inflation is much higher than it used to be, and it's not going back down. That the days of 2% inflation are gone, and we're not going to go back there again. And so inflation is going to be double or triple that number, and that is a game changer for everybody. Not only for the Fed, but for investors, because what worked in an environment where interest rates were really low and inflation was really low at the same time, the types of investments that thrived during that environment are not the type of investments that are going to thrive during a high inflation, higher rate environment, which is the one that we're in. And so investors have to recognize this shift, and they have to make the changes to their portfolios. But most of them are still wedded to what worked during the bubble, and they don't even realize that it was a bubble. You know, I knew it was a bubble because I didn't even participate. I just watched it inflate from the sidelines. But now all the assets that I've been buying for the last decade, those are the ones that are performing. In fact, if you look at our two main strategies year to date, our counts are positive on the year, and they're all in stocks. We're long stocks, we're not short, and they're foreign stocks. And even though you have about a 10% rise in the dollar, our portfolios are positive on the year in dollars. And so this is a big shift because we own value, we own dividend-paying stocks, we have resources, and this is where investors are just finally starting to shift. And I think we're at the early stages of this rotation. And so, you know, the sooner you make the rotation, I think the better, because you're going to participate in the biggest moves, which are going to happen in the early stages. And a lot of people still holding their FANG stocks, you know, and they think, oh, I can't sell them now. They're down 70, 80, 90%. You know, well, yeah, you can, because they still could fall a lot. You could buy them as a trade. I mean, you can buy it when it's down 80% and sell it when it's down 70%, because that's a big rise, right? From a perspective of a trader. And so I'm not saying that you can't make money if you're nimble and you're a trader, but if you can't buy and hold these stocks, because they're going to keep making new lows, because they don't have the valuations to support their stock prices. Now, in the past, nobody cared, because stock prices were supported by cheap money and low inflation and the mania that there was all this momentum chasing them. But when that momentum isn't there anymore, when the money is just trying to get out, because remember, there's a lot of people who own these stocks who are going to be looking to get rid of them on any rally. You know, so there's a huge headwind there. But meanwhile, the stocks that I own and the ones that I'm buying, these are the stocks that nobody owns. These are the stocks that everybody sold to buy the FANG stocks. Now they got to buy those stocks back, because you still can't hold cash because inflation is eroding away its value. You can't really buy bonds because even though the yields have gone up, they're still negative in terms of inflation. So you still have to buy real assets. And stocks are a good asset to buy, but you just can't buy, you know, an index. You have to be a stock picker. You have to buy particular companies that have real earnings today, not, you know, maybe earnings in 10, 20 years, but they're earning money right now. They're paying dividends right now, and they're selling products or services that customers need, that they have to buy, and they will buy them even if the price goes up. Maybe they'll buy a little less, maybe they'll cut back on something else in order to afford to buy, but you have to be in a position where you have the pricing power, you know, and you can stay ahead of inflation. And there are a lot of businesses that are like that. And those are the ones that we own. And that's why, you know, we have positive returns on the year. But that's also why I think we're going to have even better returns in future years once the dollar really starts to fall, which I believe it's going to do. I mean, we had this huge sucker rally in the dollar. We've reversed a good chunk of it in the last month or so, but the dollar is still, you know, higher on the year. It's lost, you know, about half its gains. But I think it's going to lose the rest of those gains pretty quickly, maybe not before the end of this year, but early in 2023. But then it's going to begin a precipitous decline. And I think that's going to be a huge positive factor for non-U.S. investments, particularly the emerging